Time for our personal finance spot, and joining me in the Auckland studio on a fortnightly basis is Mary Holm. Hello there.
Hello, Jesse.
Nice to see you.
Thanks, you too.
You're thinking about bonds, which I rudely said was not the sexiest topic that we've covered in this slot, but a very important topic because we're because most of us will be connected to bonds in some way. Certainly,
Yes.
the economy is.
Well, it certainly is, and most of us are invested in bonds, and they're not as boring as as the common feeling about it, you know. And in fact, I know that in some of the stock brokerage firms, some of the bond traders say they have just as exciting a time as the stock traders, and that, you know, is counter to what most people would think.
Because you think of bonds as being low yield, moving very, very slowly, predictable,
kind of
even
stolid, and you know, we talk about bonding with babies, and we talk about my word is my bond, and it all sounds very kind of safe and secure. And in fact, they're not quite as rock solid an investment as you might think, and I'll explain that in a minute. I don't want to get people scared, but they ought to be aware that there are some dangers of investing in bonds. Most people in New Zealand, I would say, do have some investment in bonds, often via kiwisaver. The vast majority of kiwisaver funds, going right from the low risk to the almost highest risk, will have some investments in bonds, and so and quite a few people also directly invest in bonds. They're sometimes called debentures, they're sometimes called capital notes, but I broadly call the whole lot bonds. And the basic idea is that you invest a fixed sum of money, maybe say $5,000, and you get interest payments on a regular basis, and then at the end of the period, it'll have a certain term, let's say 5 years. At the end of the period, you get your money back. So they're very like a bank term deposit in that respect, but there are some important ways that they're different from a bank term deposit. First of all, I just wanted to say, for people who are in kiwisaver and are wondering how much of that investment is in bonds, if they go onto the kiwisaver fund finder, which I'm always talking about, on the sorted website, if you just Google kiwisaver fund finder, up it will come. And one of the things you can do there is check your current fund. There's a little thing on the left-hand side. Click that, and then you start typing in the kiwisaver fund you're in, and up it will come. And then scroll down. Up comes information about your particular fund, and if you scroll down a little bit, after a while it tells you what percentage of your money is in cash, which is basically like term deposits, bonds, shares, property, and I think there's an other category. And then you can see what you've got in bonds. But if you're in a defensive fund, which is the very lowest risk, you might not have any bonds. Some of them have some high-quality bonds, some of them don't. They have only cash, basically. If you're in a conservative fund, which is the next level up, you're likely to have a lot of bonds. And if you're in a balanced fund, which is a middle-level one, you're also likely to have a lot of bonds. And then going up to the growth funds, which is somewhat riskier again, most of them still hold some bonds. It's only really the very top riskiest funds, the aggressive funds, that typically won't. So most kiwisaver funds have some bonds in them. And because of what I want to talk about today, it's just as well to just have a feel for how many you've got in your kiwisaver. So we got a letter, you and I, from George about this. So have you got that in front of you?
Yeah, I do.
Yeah.
Have you explained to us exactly what a bond is, Mary?
Well,
as I say, what it does. But
so it's a way for a company or the government to borrow money. They're basically borrowing money from you. So there are government bonds, which are the safest of all, because they're not going to renege on repaying you, certainly not in New Zealand anyway. And then there's companies that borrow money, and you go from a rock-solid company that you're almost certain will pay you back through to some very dodgy companies. And we would include finance companies in that category, some of which have proven in recent times to be very dodgy.
Were they a form of bonds, or those ones we had problems with a few years ago?
Yeah, they probably didn't call them bonds, but basically they're all bonds, debentures, all of those are really basically the same instrument, where you are lending money to the government or a company. There's also local government bonds, by the way. You've got central government bonds, and they're the lowest risk of all. And then you've got local government bonds, which are also very low risk. And then the corporate bonds. And basically, you're lending them some money and getting it back later on and getting some interest on it in the meantime. Yeah.
Okay. So here's George, and he says, "Hi,
Yes.
Jessie and Mary. Nice of you to include me, George. With the interest rates tending to go up, bonds are likely to come down in value. In the present environment, KiwiSaver investments in most conservative funds are risky since they invest in bonds. Even some defensive funds invest in bonds. So I am changing my KiwiSaver provider to defensive funds with only cash. With so much uncertainty in the world, I'm also keeping away from shares. I don't want to lose money in the next 5 years since I'm near retirement. Is this a good strategy? I suppose I'm timing the market," says George. I suspect a little bit guiltily, knowing Mary's thoughts on
Yes.
trying to time the market.
And basically, George is absolutely right about this. When interest rates go up, bond values come down, and we'll talk about that in the course of the next 10 minutes or so. And so what he's saying, if that's worrying him, it is a good idea to move from a conservative KiwiSaver fund to the defensive ones, which have typically only cash in them, or often only cash, and that's what he's thinking of doing. On his comment about timing the market, he's quite right, and George may have heard me saying, yes, don't try to time the market, which of course means pick. This is a good time to be in or out of shares. This is a good time to be in or out of property. And now I'm saying this is a good time to be at least concerned about being in bonds. And look, he's right. Generally speaking, I would say don't time markets, and in that it's not a good idea to be moving your money in and out of different types of KiwiSaver funds or other investments based on your prediction of what's going to happen in the market, because very often people get it wrong. But having said that, this is a bit of an unusual situation in that interest rates have come down and down over the last 10, probably 20 years, basically, from quite high levels. And they're, by historic standards, very low now. And so... and all the gurus are saying they can really only go up. How
Mary,
fast and how far?
What have you taught me about listening to people's predictions if only one thing can happen?
Indeed. So, look, I'm not saying interest rates will go up. I'm saying that looks more likely at the moment. In the same way that you could say Auckland property prices look worrying at the moment. You look around at the environment. So, be aware that there's quite a strong possibility that interest rates might go up again. Just prepare yourself for that possibility. Shall we say that?
Okay.
Yeah. So there are two types of risks with investing in bonds, and I want to talk about what the risks are and then how to cope with them. The first one is the sort of obvious one, and that is that the bonds default, and that means that the company or government that issues them doesn't pay you interest, and or at the end doesn't pay you your money back. And the way to be aware of that risk, this doesn't apply so much to KiwiSaver, because I would say that within KiwiSaver, the providers are probably going to be in pretty high quality bonds that don't have a lot of default risk, generally speaking. And they're diversified. They would hold a lot of different bonds. So if one out of 10 or 20 that they're investing in did happen to default, it wouldn't be a huge problem. But for people who are out there investing directly in bonds, and quite a lot of people, for example, in their retirement or going through, they've got holding shares, younger people as well, wanted lower risk investment, they might buy a corporate bond. And to tell you how risky that is, you want to look at the credit rating on the bond. And there's a link on your website to the Reserve Bank has a pretty neat explanation of credit ratings, what they are and what they mean. For those who want to quickly look at it, if they do www.tinyurl.com /credit NZ, that'll get them That'll get them
we've
to
got a link on our website too, which is an easier way. Yeah, did you write this document, Mary? I know Reserve Bank sometimes gets you to do the heavy lifting.
I didn't write this one. No, Jessie. Okay. No, I didn't. But it's a good explanation of credit ratings. And if you want to just know what credit rating a particular bond has, there are various websites that tell you that, including interest.co.nz. They have a list of the bonds that are out there in the New Zealand market, going from government right through, and they give you the credit ratings. Sometimes they say there's no rating. That means that it's a small company and or it's a dodgy company. That either way, it hasn't got a rating because the company probably feels it isn't going to get a good rating. You know, they have to apply for a rating and pay for a rating.
Who gives out the ratings?
There's Standard & Poor's and Moody's and Fitch are the three big ones.
That's right, because in that movie, The Big Short, there was some suggestion that maybe they weren't the best people to be giving out the ratings.
That's right.
They were a little compromised.
Yes, I saw that movie, and look, it is true that they, especially in the global financial crisis, there were some companies that had quite strong credit ratings that still went belly up. So they're certainly not foolproof. What these companies, Standard & Poor's, etc., do is they go out and study the company very closely and come up with an assessment. The company or the local government or whatever it is, or the country. You know, New Zealand's government bonds are rated. They get a pretty high rating. They're not foolproof. They don't always get it right, but it's a far better assessment than you or I or any ordinary person in the street's ever going to be able to do. So it's pretty good. And if you want to get what's called an investment grade bond, which means it's pretty solid, go for BBB or better. So it goes from AAA down to AA, down to A, down to that's the S&P ratings. It's all explained on the Reserve Bank website, but you want to get BBB, which is better than BB or B. So B and BB are not investment grade, and anything lower than that is not.
And that document you recommend to us also has, like, next to the BBB, it says an approximate probability of the default over the next 5 years is 1 in 30. That's quite interesting. So if you want to really kind of get an idea of what your risk is, that's quite good, isn't it?
That's right. Yes. It's a good little document that on the Reserve Bank website for explaining it in ordinary language that people can understand here. So that's one risk, is the default risk, and credit ratings will tell you, give you a pretty good assessment of how likely that is. The other risk is that the value of the bond fluctuates. And the best way, I was just thinking the other day to explain this, is to say, imagine you've got a 5-year bank term deposit, just an ordinary term deposit, and you've put your money in the bank, you put $1,000 in, let's say, at 4% for 5 years. And then interest rates go up after that. So currently you're getting 4%, and 2 or 3 years down the track, for a similar term deposit, you would have got 5 or 6%, but you're stuck in there for 5 years. Now, if you wanted to get your money out and you could find a friend to instead give you, take over the term deposit for you, they are not going to be very keen on it because it's only paying 4%, and they can go into a bank and get 5 or 6% down the track. So the value of that term deposit has actually fallen in a way. It's not. If it were for sale in the market, people wouldn't really want it very much. They're not likely to give you $1,000 for it. They're likely to give you maybe $800 or $900 because
if they had $1,000, they'd invest it somewhere else.
That's
get a better
right.
Return,
and get the current higher rate. And that's exactly what happens with bonds. The bonds, in most cases, can be sold during the period. So if it's a 5-year bond, you can, if you decide you want your money out, unlike term deposits, which are quite difficult to get out of and you usually pay a penalty, but with most bonds, they're tradable on the stock exchange. You can just go to a share broker and say, I don't want this one anymore, I want to get my money out, and they will sell it for you. You can, of course, just keep it through to maturity, regardless of what have happened. If interest rates in the meantime have gone up in the market, you can still keep it to maturity, and then you still get back your $1,000 or whatever you put in originally. But you've actually still lost value in a way when you do that, because you've missed out on getting higher interest in the meantime because the market rates are higher, if you see what I mean. Most New Zealanders, though, who do buy bonds directly do just hold them to maturity. Not many of them actually get in and trade. It's only the more sophisticated ones that do.
And I suppose there'll be some sophisticated people running some of these KiwiSaver funds who will be doing this, trying to maximise the value of the bonds they're in, getting in and out of them and jumping around.
Yes, the fund managers, they do buy and sell bonds. Within KiwiSaver, some of them will trade much more frequently than others. It depends on the kind of philosophy of the fund managers. But in KiwiSaver, and this is an important point for people to get their heads around, every KiwiSaver fund that holds bonds, even though they might not trade those bonds very often, they have to revalue the fund frequently. I don't know whether it's daily or weekly, but it's often, to reflect the fact that the bonds they've got that they're holding might have gone up or gone down in value depending on what's happened to interest rates in the meantime. And they have to do that because there are always some members taking money out. You know, they've either got into retirement and they're withdrawing money, or they're taking money out for a first home, or they're doing it because they got into financial trouble or illness. And so there's money coming out of that fund all the time. And so the fund has to work out what the value of the bonds are at the time to give them a fair market value as they're taking their money out. If they didn't do that, there'd be a big mess. You've got to treat everybody fairly. They've got to value the whole portfolio of shares and bonds and property and everything on a regular basis, so the people taking their money out are getting a fair value for it. And that's why the value of a KiwiSaver fund that holds bonds, and maybe not much else but bonds, will go up and down, even though they might actually not be trading them very often. Do you see what I mean? It's And basically the rule is, if interest rates in the market are going up, the value of the bonds that have already been issued will be going down, because people don't like them anymore, because they could get more with a new one. And the reverse, of course, happens. If interest rates go down, then the value of bonds go up. So there are times when it's fantastic to be in a bond fund. And in fact, there'll be periods within the last 5 years or so where interest rates have been falling, where the value of bond investments will have gone up, and that will have happened in people's KiwiSaver funds without them necessarily knowing why. They've just seen their fund value grow quite nicely. But it is important for people to realise that they can get negative returns in a KiwiSaver fund that holds largely or only bonds. If interest rates out there in the market are rising, the value of the bonds in the fund is falling, and so they can get negative returns. And don't be too shocked by that. It's I think we've got another letter about that.
Can I just check? Did you have a sort of a outcome piece of advice for George? You were saying that his thinking is right, were you?
Yes, and I thought what I might do is get back to George and this next letter from Natalie sort of at the end and address both of their letters, yes.
So Natalie says, "Hi Mary, I will be 65 in 3 weeks. Congratulations, Natalie. My money is in a conservative KiwiSaver fund. I check it fairly regularly these days, and for the last 3 months, the balance has dropped each month. As I will have the choice shortly of withdrawing my money and investing it elsewhere, I'd value your advice on should I go or should I stay? Thanks." From Natalie.
Should she go or should she stay? And so she has noticed that thing that she's been watching closely, and noticed that in the last 3 months...
Too closely, probably.
Yeah, well, look, there's a great argument for doing what Warren Buffett, the great share investor, says, and that is buy your shares and put the certificate in the bottom drawer and don't look at it for 5 years. There certainly can be too much watching too closely, and people get nervous because the value of their investments, well, they're happy when it goes up, but they're not so happy when it goes down. Now, Natalie, she is getting close to, and by now she probably has had a 65th because this came in a little while ago. She and by the way, we did read a whole letter out a couple of sessions ago from Natalie. This is just a sort of excerpt from it because I wanted to illustrate this example of the fact that in a conservative fund the balance can go down. But she's saying she'll have the choice shortly of investing elsewhere. And I would say, yeah, sure, but she's got to take the money out of KiwiSaver and put it somewhere else. Where's she going to put it? It might not necessarily be in a better place. The key thing for both Natalie and George, and anyone else really, is to think about when they're likely to be spending the money. It's the same old story. If they're going to be spending it within the next 1 or 2 years, maybe 3 years, it's not a bad idea to either move into a defensive KiwiSaver fund that holds only cash, which is what George is thinking of doing, or moving your money into bank term deposits, which would be a very similar sort of investment. And Natalie would have that choice because she's approaching 65, so she can get the money out and put it in term deposits, or she could leave it where it is and put it in her KiwiSaver provider will probably offer a defensive fund as well, and she could move it to that if she chose, which wouldn't be a bad idea. But either way, let me just think here. Lost my train of thought. The defensive funds, yes, if they're not planning to spend the money within, say, 3 years, I wouldn't necessarily move it from where it is. Generally speaking, people say, bond investments are okay for sort of 3 to 10 years, because usually the money will grow over a period of 3 years or longer. Over a short period, it can go down in any environment, and given that we're currently looking at, quite a strong possibility that interest rates will rise. I mean, the Reserve Bank's been saying that too, everyone's been saying it. Mm-hmm. Then there's a particular case. So if you're planning to spend the money soon, you might want to get out of a bond fund. Otherwise, I would probably stick with it, I think. Yeah.
Yeah, and your best advice about retiring is that you don't need it all when you're 65.
That's exactly right. Well, hopefully not. Hopefully you're not going to blow the lot on the big round the world trip or something like that. And you're going to pace it through retirement. I mean, there's some nonsense said about how New Zealanders should be forced to put their KiwiSaver money into some kind of annuity or something where they get a certain amount per year, because otherwise they're likely to blow it all in retirement. And I think that's an absolute insult to New Zealanders. If you've got other money, other retirement savings elsewhere, then you might take all your KiwiSaver money out and blow it. But you're not going, if this is your only retirement money, people aren't that stupid.
Yeah. And Mary has some great advice about what to do when you turn 65, about moving your money around so that it's different money for different times of your life or in different places. But you can find that on her website, maryholm.com, and look up our conversations on that. A couple of random questions that have come in. Someone wants to know what junk bonds are, Mary.
Well, junk bonds are low quality bonds issued by a company where there is quite likely to be a default. And that was a name that was developed in America. And the thing about them is, of course, that they pay high interest. That regardless of any other of whatever else is happening in the interest rates in the market, the interest rate that a bond pays is going to reflect its risk to some extent. Those companies, the junk companies, have to pay high interest or they wouldn't be able to get any money coming in. And so whenever you see a bond that's paying higher interest than the other bonds, it probably means it's riskier.
Okay. And someone just sent me an email. This is slightly off topic, but I think you can probably answer it quite quickly. Mary and Jesse, I purchased $600 worth of bonus bonds in 1991, and my balance is now $935. Hasn't changed since 2011. Should I cash them in and invest the money into something else?
So 1991 it was 600, and now it's what?
935, but it hasn't changed in the last 5 years. These are bonus bonds, post office bonus bonds.
Yeah, the fact it hasn't changed much in recent years will be reflecting the fact that interest rates have gone down. And while bonus bonds don't pay any interest, I don't think, do they? I think they just pay the bonuses, I think.
We didn't think so. Yeah, okay.
They're
not your favourite sort of investment, are they?
No, they tend to not be. They tend to, the average return on them is pretty low.
Yeah.
Yeah, if you're feeling lucky. They're quite a fun thing to do with a little bit of money, but
okay.
Yeah.
Great to have you, and thanks, Mary.
It's a pleasure, Jesse.